charts where we see this little balance area forming here, and then we see this price dropping. Well, that's you've just found the market maker price level. That's going to be your price point right there. It doesn't matter how far this falls now. This is going to be a really, really important reference price area on the way back up. And I'm not saying it's going to sell off that price area, but when you see it coming into that area, you should be aware of the fact that this was a market maker price point. So when we know it's a market maker price point, we just acknowledge its existence. It might be a single candle, it might be a tiny little spinner candle, it doesn't make any difference. There is an inflection point there that people are considering something is happening at that price point. When you look at the NASDAQ today, and we look at those price areas, when I see a break of a structure low, for example, here, somebody did something in this area here. You see this? So this is going to be a price point that is going to be of value to me to figure out something in this area, right? When we see this price breaking north, I'm already aware of this inflection price here, right? I'm able to recognize that inflection price. And obviously, nothing happens. It goes quite nicely, but there's an inflection price here. It's market-derived information. It's information that I can look at and say, something happened at that price area. I need to pay attention here. Yeah? And it's dead obvious. It's dead visible for everybody to spot. It doesn't have to be a red candle, but obviously the change in color makes it a little bit easier to spot. But at least we now know that something happened at that price, and it's likely to happen again at that price. So when the price then trades back to that area, you've got an opportunity, if you wanted to look for an opportunity to buy into it at that point. And you can see that that inflection price becomes the next rally point. We then see the next one just here, and we simply highlight that next one just in there and say that's the next one there, yeah? So when the price trades back into it, it gives us an opportunity to maybe get some business done there, yeah? And obviously that's another nice buy side pop away from this, and we can start working our ideas based on these activity levels. And you can see that this activity level leads to the next launch phase of the market move. Crazy, right? So these levels stay visible. These levels don't suddenly disappear. These are market maker levels. So when we look for these market maker levels, we're always aware that there may be activity taking place at those market maker levels. Remember, it's got to be a continuation move. Like this is not a continuation move, so I'm not madly bothered about this one. This is a bracket move here, right? So this is still an inside bracket here. This is not a continuation move here, so I'm not bothered about this balance area here. It's got to be a continuation move. So when we think about it, we're always asking the question that the continuation move is bullish. So this one might be important, and you can see a little red candle there. It's not brilliant, but you see a little red candle there, and that might be a value that's a little bit more important to us because it had a strong continuation in the direction of the continuation. When we come back into this continuation, this one's going to be important, this one's going to be important, this one's going to be important. So we recognize the most important last one is that price there, and we watch for that price area there for possible trade opportunities. When the price trades here, you can see what happens. We get a continuation short, and there's a green one right there. So we're going to be looking at that and saying, well, that's going to be important on any pullback, that's for sure, right? And you can see that it didn't trade into that area, but if it was the whole area, it did trade into it. It touched into that balance. If we take the pin there to the pin on the green, it did actually trade into that balance area right there. So that becomes important to us. When the market continues here in the direction of the continuation, there's a little green one there before the market continues again. We recognize that's going to be important to us. You see these opportunities to maybe add back into deals simply by recognizing these little continuation price points. When the price continues there, of course, we don't get anything in the middle. It shouldn't be a top edge. It shouldn't be this price. That's not what I'm looking for. I'm looking for a continuation price point, right? I'm looking for a continuation. So on the way up here, I'm looking for that candle there. I'm not looking for a bottom line candle like this one. I'm looking for that candle there. So this is going to start giving me my continuation trade area here. And I'm going to look for opportunities if I'm still bullish. And that's the big if I'm still bullish. If the price continues sell side and there's a green area there, you can see it's exactly the same price. It flips over from sell side to buy side, and this becomes a possible trade level going forward. So when you see this price moving and it pulls back and it pushes, that little red candle there is going to be an interesting inflection price going forward. So when we see the price coming back into that little area, we're looking at whether we want to be buyers from that little price point. And if we do, we get a nice buy side reversal. It pops to the upside. We make some nice monies. So we can see that there's other ones. We look at this area here. You can see on the way up here, we've got several. We've got this little fella here. It's simply market derived information. We've got this little fella here. And of course, we've got this fella here. Okay, so we've got 3 of them on the way up from these prices. They're not bottom edges. They can't be bottom edges. So when the trade comes back into this area, we get a buy side bounce. When the trade comes back into this area, we get a buy side bounce. And we're still in the same area, but we're getting less and less and less of a buy side bounce on this now. But it's still the idea. If we break out of this area, we then have this price. And if we break out of that area, we now have this price. It's just market-derived information. Now, somebody looking at this might recognize something we talked about earlier on today. Remember I showed you the market maker model? The guys that were in the room this morning, about halving the profile and halving the profile again and halving the profile. Well, if this is the first half of the profile here, because obviously there was a pause here, if this is the first half of the profile, does it not give us an idea about where the top edge is going to be? Yes or no? Do you remember the classroom we did? Looks like most people haven't remembered what the classroom we did this morning. I know that's always a challenge to remember things. But we talked about a little point here. And if we then talk about a point there and we see a price dropping from that point, and it then balances here and we get a little pause here. If I was to look at that, I would be saying to myself, well, if that's truth, what's going to happen is we're then going to halve again, and there's going to be another pause here, and then we're going to halve again, and there's going to be another pause here, and we're going to halve again, and there's going to be another pause here, and then we're going to reach what's called the measured move. Yeah? So if I can identify that point, if I can identify this price, can I identify this price in advance? Well, it can have a bloody good shot at it, right? I can have a pretty good shot at it because we should see on the way to this price, we should also see that price level there at least, right? So before we reach this price, we can get confirmation from that point there, can't we? So let's see what happens. If this is point 1 and that's point 2, I can now come up with the final point, agreed? Point 1 and point 2, I can come up with the final point. And there's the final point reference right there. You see that? So there's my final point reference. Now, if that's my final point reference, I should see a point reference at this point here, agreed? And what do I see at that point? Exactly what we thought we were going to see at that point. Do you see that? No? Yes? So this confirms that this is likely to be a sell trade. This point here confirms that that is likely to be a short sell. And that gives us a lot more confidence to work into that as a top line if we want to work into it as a top line. Every move has this quality about it. Every single move has this quality. As the price sells off here, this green pop here tells me where the next pop's going to take me to. It's the same process. So if this was the green pop here and this was the top edge, I now know from that point there to that point there that this pop is going to take me to this area here. If it takes me to that area there, I can then start thinking about the slowdown process that's likely to start developing from that point. It allows me to start considering where these elements are. If this was a sell, we got a green phase here. That means that there's likely to be a sellable opportunity again here. And there is a sellable opportunity here for that continuation at that point. So we then have a bracket structure from here to here, and we know about that bracket structure from there to there. We know that this point is going to be interesting, which kind of makes a bit of sense, because we can obviously look at this and say, well, there's now the new bracket structure there. And based on that bracket structure, there should actually be, more realistically, there should actually be a green candle here. And if there's a green candle here, there should be another green candle here. And if there is another green candle in any of these two areas, it is almost definite that this is going to be a buy trade opportunity here. Just the same way as that was almost definitely going to be a sell trade opportunity. So in other words, we can map out these elements, can't we? And sure enough, as we come into this little area here, we can see that there is now a buy trade coming in at exactly that point, surprisingly enough, as there was a buy trade came in at this point, surprisingly enough. This is market maker math. This is the basic cornerstone of simple market maker arithmetic or market maker maths. Understanding where the market makers can aggregate statistically, make a little bit of sense. These are very, very straightforward. Finding these little market maker areas and just observing if they show up helps to firm the market maker strategy that's going to be adopted in these higher prices or lower prices. So when I come off a bottom edge here and then I see a pivot here, I can now start coming up with my target top line. I can now see that this is going to be an area that the market maker will massively aggregate into. And we start building our ideas around that as a process, and we can do this anywhere. And the only reason that that existed was because of that candle. Because of that candle, I'm able to construct a market maker strategy for this. And then when that candle confirms, I need to see something here. Because if that doesn't confirm here, this is not confirmed. This does confirm here, and therefore that is confirmed. It makes a high probability sell coming away from that price. Does that make sense? So we can follow the footprints of the market maker aggregations. Because when you think about the math behind those aggregations, it makes so much sense. Because this is how they balance at very, very small corrections, right? So when you think about a move like this, in the early stages of a sell-off, the market maker is likely to pull their liquidity really hard and really fast so they don't get filled, right? So they hit the first price point. And they maybe buy, let's say they buy 10 contracts here. Now, obviously, at that stage, they've only bought 10 contracts, so the bounce will probably be minimal. But now what's going to happen, of course, is the market maker needs to now think about where they're going to aggregate. And then obviously when the price hits this price point here, the market maker is going to aggregate with 20 contracts, right? So for argument's sake, they're going to buy 20. Yes, it's a martingale. Martingale is used all the time for market makers. So the market maker buys 20, which means they're now long 30 contracts. But if they're long 30 contracts, it doesn't take much of a bounce. It only has to go back 1/3 of the way to break even, right? The price doesn't have to go back to here. The price actually only has to go back to about there to break even for the market maker now. And obviously, if it bounces, and obviously you get an idea that if it bounces there, you can see that the market maker you could easily aggregate here and then mitigate the risk here. But obviously the idea now is that this is now giving us a lot of proof that the market maker is going to hammer this price area here now. They're going to start somewhere between these two prices, they're going to start hammering it. And they might do, say, 50 contracts. So in this area here, this little space here, they're going to do 50 lots. In other words, you'll see a massive increase in volume hitting the books. And we'll see this big old spike in volume as the price trades into an area like this. And we'll see this very fast money reversal coming out of that area. And realistically, if 50 contracts are filled here, and 20 are filled here, and 10 are filled here, it doesn't have to bounce very far for the market maker to make a profit, does it? It doesn't have to get back to this area here to make a profit. It really only has to bounce a little bit to make a profit on that market making situation right there. But we can verify this by recognizing this. It starts to make an awful lot of sense in these areas. So we can start to spot these areas. Well, this is all it is, Ulrich. That's all it is the idea of 1 and 2 sigmas. Because obviously this price here must be a measured move. So when we start doing measured moves on top of measured moves, we start getting 2 sigmas. So if the price is aggressive enough to hit 2 sigmas, the market maker, we should see evidence of that market maker doing some business going into those areas, allowing us to make these easy money decisions. This is a brilliant example of being able to spot the market maker in operation. You know, we should have had an idea about where this red candle would be, because that should be a measured move against that bracket, right? So there's the bracket high and there's the bracket low there, right? So we're on the bracket. So I expect the first red candle to show up at that price there. Is that where the first red candle showed up? Yes, it is. So when we see the first red candle coming in here, we can readjust our measures to make it more accurate. But even at this stage, even at this very early stage, you now think that the top line is going to be right there because that's the 2 sigma price. At that point there, the top line is going to be the 2 sigma price right there, isn't it? So we can understand the idea that that's probably going to be the market maker's end of the game, but we can improve on that accuracy by watching the individual elements that brew prior to that. So when we get this balance area here, we're now looking at half the distance, which is now this one. And then we're looking at half the distance again. And if we get half the distance, which was this one, we now know that this is now going to be definitely a market maker top line. And this is now a very high probability top line sell. And from that very high probability top line sell, we've now traded all the way down to this prior level here. And now we're trading to this prior level here. And obviously this sell here, this buy trade has become a sell trade because there's the little pause. And we can now look at that sell trade there, and we can keep working our way back out of these tradable areas. From point to point, it's crazy accurate, isn't it? Crazy accurate. It doesn't mean that we're buying here, and it doesn't mean we're selling here, and it doesn't mean we're buying here, and it doesn't mean we're buying here, or buying here, or buying here. It just means we know about these levels. We have a map to overlay on top of our charts to find these market maker price points. Another way we can find these is to find voltic areas. If we find an active voltic area and it's a continuation price, you should be marking that price, shouldn't you? You absolutely should be definitely marking that price. So if you find a voltic on a moving market, but it doesn't reverse the market, it doesn't matter that it doesn't reverse the market. It is a very important price point going forward, even on something like the 10s. If you look at the 10s here, on that market drive higher, can you see the voltics that don't change the direction of the market? It doesn't matter that they don't change the direction. That price there is really important to me because the market maker did business here, suggesting that the slowdown can now be calculated. But as well as the slowdown being calculated, I now know where the bracket range is. It's going to be that price. And sure enough, as soon as it touches that price, the price on bonds bounce. Very clear, very obvious when we see that developing storyline. If I look at voltics on the way back down out of this area here, can anybody spot the areas? Well, we had big voltic area here, so we pay attention to that area, don't we? We had a big voltic area here, so guess what we're going to do? A continuation, so we're going to pay very close attention to this voltic area here. Guess what happened? Sold away from it, and it sold away from it. Now, the reason why we're not paying attention to that voltic area there is because it didn't have continuation, nor did this voltic. The voltic here bounced and the voltic here bounced, suggesting that the market was going back in the other direction. So these levels become less important when we start seeing voltics stopping the market instead of continuing the marketplace. If you get a voltic balance and then it continues, That level is very important. When we get the next voltic balance and it continues, this level is very, very important to us. Very important. So we pay attention to it. Make sense?